Hello, everyone. Welcome back. This is session two. Hopefully, if you're watching this video, you've watched the first session where we covered our baseline foundation, financial foundation, building an emergency fund, budgeting, understanding where your money is going in and out. And here we're going to build a little bit off of that. I'm Carolyn Mullins. I've worked for 12 Points for 2 years now. I came straight out of college. And so I feel as though I was just in college, I was just in high school. I'm still somewhat new to all of this, but I really enjoy teaching anyone, whether it's younger teenagers or my friends or my parents, my neighbors. This is something that I enjoy. I can talk to a bunch of different people about in all different levels. And it's just so important talking about personal finance, and everyone's gonna have to deal with money and salary and what to do with it at some point in their life. So great to get started young. Hopefully, the people watching this learn something from it.
Awesome. I'm Joey Belsanti. I've been at 12 Points going on 4 years now. Wow. First few as an intern, and I graduated from Bryant University in May 2025. So I have just finished up my first full year here. I work on the business advising and wealth management sides of 12 Points, and I also lead our nonprofit 12 Points Academy, where we work with mainly college and high school students, preparing them financially and professionally for the real world. So I really enjoy talking to students about financial education, really how to prepare themselves to handle their money with confidence. And I think it's great that us at 12 Points here, we're now bringing it to the children of our clients as well. So I'm really excited about this. Like Carolyn said, the first session we went over our financial foundation. So really taking care of our everyday needs, saving, budgeting, paychecks, income, and then how much are we actually receiving from the income and how much are we taking home. Today we'll be building off of that. So last session covering building the base to which we're able to build off of securing financial safety, and now building off of that towards financial freedom, building wealth through investments in credit. So we'll be diving into that. Right now is usually the time we would stop and ask the students or the attendees what questions they may have regarding investing, credit, or really just finances in general. And we would really work to weave those into what we already have prepared. We don't like to strictly go off of the deck we have. We like to really work in the topics, questions, anything that who we're talking to is most interested in. Unfortunately, today is a recording, so we will dive right into it. Anything else, Carolyn?
No, that's all. Let's dive in.
All right. So we will start with credit cards, credit scores, what the difference between a credit card and a debit card. Then we will dive into beginning to invest. So beginning our investing journeys. And then we will end with some action items, some ways to implement what we learned here today so we can see the difference in our lives. Like I mentioned before, last session we talked about our financial safety, really covering our everyday needs through saving. Today we will work towards building wealth, that leading to achieving financial freedom mainly through investments and credit. All right, credit and credit score. Diving into this. What is a credit card? So when I ask this question to high schoolers and unfortunately college students as well, they don't have a great idea of exactly what a credit card is. Essentially, a credit card is a short-term loan. It is not, when you swipe your credit card or tap your credit card, you are not using your money. You are using borrowed money. Now compare that to a debit card. A debit card is when you tap or swipe a debit card, that is your money coming out from your bank account. Carolyn, I know you really think this is an important point here, debit versus credit, and making sure people
Hmm.
understand. What should people be aware of when using a credit card?
Yeah, the biggest thing is So with a debit card, you have that money in your account. The second you use it, it gets pulled from your account. The credit card, you don't have to have that money readily available. It's not pulling straight from your checking account as a debit card will. So what you have to be careful here is that when you're swiping that credit card and you're buying stuff, that you're able to pay off what you're buying at the end of the month, and that money is coming from somewhere where I like to say treat a credit card as a debit card. If you are using your credit card, make sure you're able to pay it off immediately and that you have that money available. If you're acting as though, oh, I could put it on my credit card because I don't have that $200 to buy that right now, and maybe I will later, or I'll get paid in a week or two. That's not the mentality here. We want to be putting stuff on the credit card that we're immediately able to pay off just as we would a debit card. It just is treated a little differently. The big thing is the interest rate with the credit cards. So we did talk about interest rate last week in regards to a high yield savings account. And in that instance, we're giving our money to the bank and they're thanking us and giving us an interest rate back. And they're giving us, say, 3% on the money we put in their account balance. They start giving us 3%, thanking us for using their bank. Here, the credit card, like Joey said, it's a loan. So we're using that bank or this financial institution's money, and then we're paying it off at the end of the month. So since we're using their money, they tag an interest rate to it that we would pay to them, thanking them for using their money if we don't pay it off by the end of the month. So they expect you to pay it off at the end of the month, your balance. They encourage you to. Otherwise, the interest rate that you'd be paying them if you hold a balance with them, and sometimes there's a minimum you can pay off, but in general, if you're holding a balance month to month with them and you're not paying it fully off, the interest rate is up to, 25, 30%. So you take $100 on your credit card and you're not paying it back to them, they get a little mad. They want that money back. They're going to demand 30%. So now your balance is $130 for only $100 that you spent. That's where it gets tricky. And that's where we see a lot of people spiral into credit card debt because that interest rate is so high that they're unable to pay it off. And then that 30% hits their account and their balance goes up. And they're not able to pay it off. And that 30% comes in, hits their account, their balance goes up. The line of credit, that's the limit you're able to spend on your credit card. Say it's $1,000. So every month the financial institution that your credit card is from, they allow you to spend $1,000 on it. Of course, they expect you to pay it back or else they're going to charge interest. But they allow you to spend $1,000. People asked last week, what happens if you go over that $1,000? And I said, let's not find out. But we think we're pretty sure they'll shut you off, and you will not be able to go over that $1,000. That is your limit. Your line of credit is your limit. If you pay it off, then you can use it again, and you just cannot have that balance go over that number. Anything else to mention here, Joey?
No, I think that's a great point to move on to what actually goes into a credit score. So you mentioned a few things there, Carolyn, that we don't want to do and will unfortunately impact our credit score. So when we talk about credit score, essentially it's a number that rates our credit worthiness. So how trustworthy we are with credit, or these financial institutions think we are with credit. And what that looks like is a number between 300 and 850 that scores us on how trustworthy we are with credit. Essentially how good we are with using credit. Are we paying it back at the end of the month, on time, every time, in full, things like that. So, Carolyn, do you want to kind of go into why credit scores are important and how they're calculated?
Mm-hmm. So credit scores are important because they actually allow you to um, prove how responsible you are, how creditworthy you are, how trustworthy you are borrowing other people's money. So the biggest example here is when you're buying a house. A house is many people's largest asset. It's a ton of money. They're going to live in it for so long. They spend hundreds of thousands of dollars on this house. They're not paying, whether you know this or not, they're not paying for it all cash out of their pocket, using their debit card for this house. They're spending some money on it, and then they're getting a loan from the bank called a mortgage. So this loan from the bank, the mortgage, can be hundreds of thousands of dollars. And it's normal and it's great to have a home. And, this is something basically everyone does, but that is a huge loan. And the bank knows it's a huge loan. And so they're looking at your credit score and saying, how good are you at borrowing money? Usually we build that from the credit cards, which is much smaller than a couple $100,000 loan. So the bank's looking at your credit score and saying, "Wow, Joey, you are great with credit. Got a 800 credit score. So we trust you, giving you this huge bank mortgage loan for your home. And we trust you so much that we're going to make your interest rate a little less." So for mortgages, remember we said we're borrowing money, so we have to pay interest on that money to the bank, thanking them for letting us borrow that money to buy this home. The interest rate on hundreds of thousands of dollars can be a huge number, and we have an example actually on the next slide. But the bank will actually lower that interest rate if you've got a good credit score. This can also come into play with cars. Cars are big loans that you might get if you finance your car, and they'll look at your interest rate, how good are you at borrowing money, and they might give you a little bit of, or sorry, they'll look at your credit score, how good are you at borrowing money, and then they might give you a little bit lower interest rate, or maybe a higher one if you don't have a great credit score. So it's good to start building that early. How it's calculated, if you look at the bottom left box, the amount of credit outstanding. So do you have 14 different credit cards out there? Do you have 10 different personal loans in your name? How much are you borrowing out there? It's the forms and the amount. So do you have, credit cards, student loans, personal loans, mortgages, all different types, and then what's the dollar amount that you're currently borrowing? They're going to look at that to calculate your score. They're going to look at your repayment history. A responsible borrower that we want to be is repaying on time every time. And then that'll do good for your credit score. Length of credit history, that's when we say you want to start building it early, because the more time you have borrowing and experience you have borrowing, then you're more trustworthy. The bank looking at a person trying to get a mortgage who's, 24, 25, they only have had a credit card for 2 years. They don't know how this person's going to do with this huge mortgage payment. A 50-year-old who's getting a mortgage that's had credit cards or other loans for 30 years, they've got a lot of experience. The bank goes, "Oh, they've got 30 years under their belt. They've never missed a payment. They're good." And then the percentage of credit you used. So like we said with the credit cards, if you have $1,000 limit, that doesn't mean the credit card company and the agency that calculates your credit score wants you to use that limit. That's what we call maxing out your credit card. They don't want you to, push the boundaries and always be spending that $1,000. If you have $1,000 limit, maybe they want you to be spending $300 max, because they don't want you maxing it and pushing your limits, and it's just not showing that responsibleness that they want. So how to build good credit, I just went through all those different ways on the left on how it's calculated. Do the good things. Pay the bills on time every time. Keep the balances lower, not at the limit. Don't have 15 open accounts out there, open credit cards, and starting early to have that history behind you.
Start early. I know that was a theme of last week as well.
Right.
It's especially important here as well. Unfortunately, it's just you got to play the game, kind of, to be able to increase your credit score. You have to start early and show how responsible you are with credit early as well. So, um, let's go to the example here.
Mm-hmm.
In Massachusetts, the average mortgage loan is around $460,000. Your credit score can make a huge difference in how much that loan actually costs over time. So we have the 30-year mortgage broken down between an 800 credit score and a 600 credit score here. Now, like Carolyn mentioned, a higher credit score is more likely to have a lower interest rate associated with the loan because they have shown that they are more responsible with credit. Compare that to the lower credit score. So compare the 800 to the 600. The 600 has an interest rate of 8.5, while the 800 has an interest rate of 6.5. So the monthly payment breakdown is just over 2,900 a month for the 800 credit score and just over 3,500 a month for the 600 credit score. So over the life of that mortgage, the total interest paid between the 600 and the 800 is $225,000 more that the 600 credit score pays than the 800 credit score. So that's almost $7,500 a month and $619. I'm sorry, $7,500 a year and $619 per month. So there's a lot of stuff you can do with $619 on a monthly basis. I really think this is a great example of the power of being responsible with credit, especially early on, building up the credit score, and the effect that it has in real life as well. So it's not just numbers on a screen. It's not just, 600, 800. Oh, there's really no difference. There's a true difference when you look at a real life scenario such as mortgage. Anything to add, Carolyn?
Yeah, just start those habits early. You know, the earlier you get comfortable with just a routine, you pay it off at the end of the month. Don't go too high on your balance, and just starting early, getting comfortable with that, and then you don't even have to think about it because that's your habit. But once you start bad habits of spending too
Mm-hmm.
much, hitting the max, not paying the balances at the end of the month, it's hard to get out of it.
All right, moving over to risk and reward, really our introduction to investing here. So, the first thing we want to cover here, before we even begin investing in anything, we want to figure out our risk tolerance. So, we have included in here an abbreviated risk tolerance questionnaire, 3 questions, but I hope this gives us an idea of what a risk tolerance questionnaire looks like, what is risk tolerance, and why it's important. So before we even put money into any market, any type of investment, we want to think about when do we plan on using this money? When will we need to access this money? Is it less than 3 years, so the short term? Is it 3 to 5, 6 to 10, so maybe the medium, a little bit longer term? Or is it 11 plus years? So really looking out to the future. Are you most concerned about losing or gaining value from your investment? Do you just want your value to stay the same? So what are you comfortable with and what are you expecting from your investment here? Then also imagine that your investment account balance goes down by 25%. So what that looks like is from 10,000 to 7,500 here. And what would you do if that were to happen? Would you sell all of your shares? Would you sell some of your shares? Would you do nothing? Or would you buy more shares? So what figuring out our risk tolerance does is that it makes us think about when will we need this money? What are we comfortable with? Or how much risk are we comfortable with? And really, these things inform us on where we want to put our money when we start investing, when we start getting into the market here. So, Carolyn, do you want to break down kind of the line or the different buckets that there are for your own risk?
Hmm. Starting on the left, conservative. That's what we call, maybe you don't want to lose any money at all. Maybe you're only comfortable losing a little bit of money. This is commonly, maybe you've got a short-term goal. So that first question you said, I am saving this money, but I need it in 2 years for a down payment on a home. That maybe you want to be very conservative with that money because in 2 years you'll need that $100,000 for that down payment. And you don't want that money to go down because then you're not able to make that down payment with that. that would be what we call conservative. Conservative investments are generally maybe CDs at your bank, maybe bonds, which are lending money to companies, and they'll pay you an interest rate for lending the money, and then you'll eventually get your original investment back. And then you can also do that with the government, and those are treasuries. And the US government is very, very safe when it comes to bonds and short-term loans, which are investments that you can do because the government can print more money and pay you back. They're very conservative, safe investments because you are almost guaranteed to get that investment back when it comes to the government. There's a bunch of different investments out there. As we get more aggressive to the right, what comes with more risk is possibly more return. So the point people start dabbling with individual stocks, buying a share of a company such as Apple or Netflix or whatever that may be, that's when you start going to the right and you're getting more aggressive, as we call it. And the more risk you're taking, because if you're putting your money in this one company and that company could go do very well, and maybe some news comes out and it completely tanks and goes down. That's risky. So the more you're going into individual companies and such, you might get a higher return, but you might get a lower return too. Whatever comes with more risk, there might be more return, potential return, and that's why people take on more risk. So very aggressive. We can talk about, private investments, and that's not even available to everyday people. And maybe you have to go through special partners to get into those private investments, or maybe it's real estate, or maybe it's gold. And there's a million different investments out there, and Joey will talk a little bit about them, but kind of seeing when do I need that money? How comfortable am I with risking, doing the math, say, what if this goes down 50%, 20%? Am I okay with that if I see that balance from 10,000 to 7,500? Because I might also see a balance that goes up, and just knowing what goes down might go up, what goes up might go down. Um, really getting a feel for how much risk am I comfortable taking, and then trying to incorporate that in your portfolio, which we'll talk more about different investments next.
What is the market? So Carolyn mentioned different investments. There's not just different investments, but also there's different markets. And when we talk about the market, most people think about the stock market. But as Carolyn said, there's also such things as bonds, and there's the bond market. There's such things as different types of currencies, whether that be the dollar, the peso, the yen. So there's a currency market that we can trade as well. Physical assets such as commodities, whether that be gold, um, beef is actually a commodity, nickel, cobalt, different types of metals and precious metals, and things like wheat. And I think orange juice is actually a commodity as well. So there's a lot of different physical assets that we can trade in the commodities market. Options and derivatives, which are more complex types of investments that we will not be getting into today, but those can carry more risks than typical investments. So looking into the stock market, or focusing more on the stock market, I imagine some of you might have heard of something called the S&P 500 before in relation to the stock market. So Carolyn, do you want to bring us through what exactly the S&P 500 is?
Yeah, I think Joey and I both agree that the S&P 500 is thrown out a lot, and maybe that's what people are referring to as the stock market. The stock market went up, the stock market went down. I think a lot of the time people are talking about the S&P 500 index. And what an index is, and what the S&P 500 is it's tracking a bunch of companies. It's not the entire market of every single company in the whole world or just the United States. This one in particular, the S&P 500, is tracking the largest 500 companies in the US. So, that's Apple and Amazon and those big giant household names that you know of, that's in the S&P 500 and that's a huge piece of the market. But this specific index is tracking the largest 500 in the US companies. Um, there's a bunch of other indexes out there if you want to see, these are large companies. There's middle-sized companies, mid-cap. Then there's smaller companies. Then there's indexes that track outside of the US or everywhere or just, European markets. A whole bunch out there. I think the S&P 500 is just thrown out a lot and is very common. And we do have, some huge companies in the United States and they're important and they're doing big things. But this is a popular one and there's others out there. This chart on our little computer here is showing the S&P 500 from its start and then where it's at now. And you can see that over time and over decades and decades, the S&P 500 has gone up a lot. But if we were to zoom in and only look at, a 5-year period at a time, it would go up and down, up and down, and up and down. And sure, over decades and decades and decades, it's gone up. But people were riding the wave. They were going up with their investments. If they were in these companies, they were going down with their investments. But over time, the stock market as a whole and the 500 largest companies in the United States have grown. And they do change, they do keep up with this 500 companies, and maybe it's not the same 500 as, 45 years ago. They do change and update, but overall, you could see how crazy that chart is. Anything to point out on there, Joey?
One thing that we've been pointing out recently is, especially when we're talking to younger kids, even us and our age, we
Hmm.
have really experienced levels of growth in the market that are not typical. And if you go back to the 08, 09 Great Recession, even before that with the dot-com bubble, it's been very typical for the market to go through ups and also very typical for it to go through downs as well. Recessions have been a normal part of the market function. Um, Recently, though, it feels like the market has been doing nothing but going up, especially since COVID. And when I talk to younger kids, they think that is the only outcome for the market is for it to keep going up. So they are willing to take on a lot of risk because they have not experienced the downside of that risk. And something to point out with risk and reward, there's a relationship between both. The more risk you're willing to take on, yes, you're willing, or there could be more reward associated with it. However, there's also the possibility for more downside as well. So the more risk you take on, the more reward and the more downside there are. The less risk you take on, there's less reward, but also less chance of downside for associated with that as well. So it's very interesting talking to the young generation of kids right now and kids our age, Carolyn, when we talk to
Yeah.
others about this, because they have a big appetite for risk. And I think it's associated with not experiencing really the downfalls in the market as
Hmm.
of lately.
And
And then also just one other thing here. So oops, I'm skipping ahead here. As we go back to the different buckets here, and then also the different markets here, each market and each different investment within a market carries different risks. So we want to, and that's why it's so important for us to identify our appetite for risk, because that will inform us on what we should be comfortable investing in. And not just risk, but also when will we need access to this money. So that will inform us in, oh, do we not even invest this money because we're going to need it within the next year or two? So we keep it in a high yield savings account or a regular savings account, a CD, where we know we'll be able to access this money either immediately or in 6 months or in a year in regards to the CD. Or if we don't need it for a few years, we can put it into the market. But then also within the market, there's different investments, different vehicles that offer different points of liquidity as well. So like Carolyn talked about private investments, which we won't get into today, but your money is locked up in private investments for X amount of years, compared to a stock where you're able to buy and sell stocks on the regular or more easily than accessing funds in alternative investments, private investments per se. So just pointing that out before we hop into some specific investments here or investment vehicles that we like to talk to kids just beginning their investment journeys. So those would be index funds, mutual funds, and ETFs. And we won't get into the true specifics of each individual vehicle here, but we will dive into some of the broad similarities between them because we feel like it's very valuable to point these out and why they're valuable to start on your investment journey. So each of these different vehicles, index funds, mutual funds, and ETFs, they each pool money from many investors, so many different individuals. They pool it to then invest or buy in a basket of stocks, a basket of bonds, or other securities, such as commodities. So a single purchase gives you instant diversification within that big basket. And with that basket can either be in a single sector, like Carolyn was saying, with small cap, large cap, technology, healthcare, or it could be more broad and include many different sectors. So there's a couple different ways you can get diversification. You can get diversification within a sector or within an industry. Also, you can get diversification across different industries and across different sectors as well. And what these different vehicles offer also is professional management. So it's not you picking a single stock and having to worry about the performance of that singular stock. Here, there is a portfolio manager or a fund manager who makes those decisions for you or for the entire pool of investors. And what they do is they look at the performance of the different securities in that fund and they make decisions on how to handle that fund or that portfolio, so you don't have to worry about it on a daily basis. So, because there is that professional management within these funds, there is a cost to these funds, and what that looks like is a percent of the overall growth of the fund. So, let's say the fund grows 7%, for example, and there may be a net cost of or a net expense of 0.2%. So that means you would net the 7 minus the 0.2, so you net 6.8%. That's just one example. But we want to be careful of these costs because they do vary. So some of these funds may have a higher cost than others. I'm pretty sure ETFs usually have the on this list the lower costs associated with it. However, they vary from fund to fund. Some funds may have higher net expenses than others. We want to be careful of that. However, on a broad basis here, for the professional management, they offer low cost considering, and it's a I believe a good way to just get exposure into the markets, as a beginner. So it's not picking and choosing different stocks. You're investing into a potentially diversified vehicle here that is managed for you, so you don't have to exactly worry about it. And the stock market does during the day, it's a minute by minute thing. So when I began investing, I did not take this route, which I wish I did, and I was glued to my my investment performance on a daily basis or throughout the day, which is probably not the best thing. Because when we invest into the market, we want to we don't want to be worried about daily volatility. We want to most likely let it sit there for the medium and long term and hopefully let it grow over that time. So we don't want to be too concerned or too crazy about the daily ups and downs because they do happen, as Carolyn said. There's volatility in the short term with the expectation that over the long run there will be growth. Carolyn, anything to add here?
No, just a summary and just so people don't get caught up on the costs. What you're buying essentially for not. It's pretty inexpensive. Professional management. So if you know you want to invest in some international companies, um, instead of going out there and picking, 10, 5, 10, 25, however many international companies you want, you can buy, an international ETF or an international mutual fund. In that one investment that you bought, this international one, that's going to hold a ton of different ones that a professional behind the scenes picked and put the research into, and they're doing the work for you, and you know that hopefully you've looked at some of the stats behind it and um the small text behind the scenes, but it's not you going out there and finding 25 different companies and doing all that work. You just know that this is a good investment in general for international funds. I think it's worth it. Like Joey said, then you're not glued to every stock every day and the headlines of, oh, what did that company do? What did that company do? Because you've got someone professional behind the scenes building that pool and basket for you.
Mm-hmm. Well put, Carolyn. So I think on the next slide here, we have a few other accounts. We went over broad investment and retirement accounts last week. Today we want to focus more so on 401ks and IRAs, what they are, but especially highlighting the difference between traditional and Roth. So each a 401k and an IRA can both be traditional and Roth. So you can have a traditional and Roth 401k and a traditional and Roth IRA. And what IRAs are, it stands for individual retirement account. 401ks are a corporate sponsored retirement plan that employees of, and there's some complexities here, but essentially that employees are able to participate in and contribute into, with the possibility of that employer actually matching some of that contribution as well. So what traditional Roth and 401k, or sorry, a traditional 401k and IRA essentially means is that you're funding it with pre-tax dollars. So before your income has hit taxes, so whether that be income taxes, Social Security, Medicaid, you are funding it with the funds before it hits those taxes. And however, when you withdraw those funds closer to retirement, you then have to pay taxes on the withdrawal. Roth, however, you're funding with pre or with after tax dollars. So it has gone through the different types of taxes within your paycheck or your income, and then you are funding it post tax. So when you withdraw near retirement from a Roth account, you are withdrawing in that the funds do not get taxed, and also the growth in that account is not taxed as well. So there's some different reasons why people would fund a traditional or a Roth account. It has to do with some tax implications, stuff like that, whatever tax bracket you're in. But Carolyn, do you have anything else to add here?
Yeah, so the with these two, the question is, when do you want to pay the tax? Do you want to pay the tax today, which is the Roth, you're paying the tax, then putting it in the account? Or do you want to pay the tax maybe 10, 20, 40 years down the line when you're taking the money out of the account, which is the traditional route? So, do I want to pay the taxes today? Do I want to pay them in the future? And that's what you're kind of juggling. Well, we don't know what tax brackets are going to be in the future, but maybe I'm 55 years old and I am at the height of my career. I'm making as much money as I've ever made in my career, and I don't think that in retirement, when I actually start using these funds and pulling them out, I'm going to be at the same high income tax level bracket. So that's when you wouldn't want to pay the taxes now. You'd pay them in retirement when you think you're going to be in a lower tax bracket. Of course, we never know what those tax brackets will be later. But for Joey and I, great example, we just started our careers. We're young. We're hoping that 10, 20, 30 years from now, we're making more money than we are today. In that instance, we're going to be making more money, we're going to be paying more taxes, and maybe even in retirement, we make good income from a bunch of different things, even though it's retirement. And so we want to pay those taxes today. And that's why Joey and I pick the Roth because we're young and we think our tax brackets are really low right now, and later in life we're going to be making more money and they'll be higher. It's a guessing game. If you are, say, in the 12% tax bracket today, and you're in the 12% tax bracket when you take the money out, whether that's 10 years from now, 45 years from now, however old you are, if you're putting it in at the same bracket and taking out the same bracket, it doesn't matter. So it's kind of a guessing game of which one. We do like to have our money in different buckets just for flexibility. So, maybe I'm starting out with Roth now, and in a couple of years I'll switch it to traditional. And it helps to have those options. Um, yeah.
So here's a graph, one of our chart, one of our favorite charts here at 12 points, looking into really essentially contributing to a retirement plan starting early. So we have two guys here, Joe and Phil. Joe contributes $5,000 a year to this plan from years 1 to 10. Phil contributes nothing from 1 to 10, but from years 11 to 50 contributes $5,000. So Joe here, only contributing $5,000 for the first 10 years, ends up with 1.7 roughly million dollars, while Phil here contributes for a total of 40 years compared to Joe's 10 years, and he only ends up with 1.4, little under 1.4 million dollars. So Joe only contributing for 10 years ends up with more money than Phil at the end of the day, who contributes for 40 years. So here it shows, it really emphasizes everything that Carolyn and I have been talking about the last 2 weeks here, starting early, why it's so important, and how we take advantage of really the time value of money and really compounding our returns over time. So the sooner you start investing, saving, if you are if you have a job and start contributing to a 401k or some sort of retirement plan, the earlier the better because you're able to then take advantage of time, the more time you have before you actually have to access those funds, start withdrawing. And also, as Carolyn was saying, we're in our stage of life, and especially those who might be in college still or young professionals, we may not have a lot of expenses currently. We may not need to spend really too much money, so we have a great opportunity to save and invest our money now. Let it let it hopefully grow over time, and we'd rather save and invest more now rather than saving and investing a lot more when we're forced to, if we're not, down the line when we're in our 30s, 40s, and 50s, because we didn't do it enough early on. Um, Carolyn, do you have anything to add to that?
Yeah, remember that this is, yes, we're saving $5,000 a year in this example, but we're putting it to work. We are investing this, and that means some years it's going to go up, some years it's going to go down, but in this example, over the 50 years we're talking about for Joe and Phil, your money is going up at an average of 8%. So that money is working for you. You're saving it, you're investing it, and starting early, it just snowballs and snowballs and gets bigger and bigger. And you don't want to be, like Joey said, the person playing catch up and trying to save more later in life, and they don't have that big time factor on their side.
And just quickly here, I mentioned employer match within a 401k earlier. So what that essentially is if you were to, let's say your employer offers a 3% match. So if you contribute 3% to your 401k, that employer will match it. So then you are actually getting 6% contributed to your 401k. If you contribute, let's say you contribute 8%, your employer will still match that 3%. So you are actually getting 11%. If you only contribute 2%, your employer will only contribute 2%. So they will contribute up to that match, and it is free money almost. If that's why we like to talk about the importance of at least contributing up to that match because it's free money, if you can. And starting early, as we were saying, it's really the best time possible to start that saving and investing. So if you can at least get up to that employer match,
Hmm.
we say do so because it really pays off.
Absolutely. At least get that free money.
All right, so some action items here. Carolyn, do you want to bring us through these action items?
Sure. First one, make a plan for building credit. So if first off, I want you to start with at least a debit card and getting in the habit of if you're spending money that's coming out right away. Then, when you're comfortable, maybe talk to your parents, maybe get added to their credit card or talk to them about that, or open your own and get in the habit that you had with that debit card of if I'm spending it on the credit card, I'm able to pull it right away from my account and setting up the good habits of credit where you're paying that off every month, you're paying it in full, you're not using that full max that they're giving you. You don't want to be maxing out your credit cards, and just building those habits healthy and early. Um, was there one more thing I was going to say about the credit card? Maybe not. Begin thinking about your investing journey. So we talked a lot about last week saving at least 20%. Of course, getting those first everyday needs saved for first and making sure you've got that emergency fund if anything goes crazy or there's quite literally an emergency, having that safe money in the savings account on the sidelines, in your high yield savings account. Maybe you're saving there for short-term goals too. But when we're talking about medium and long-term goals, or you start a job and you've got retirement accounts like a 401k, that's when we start talking about putting that money in investments and putting it in the stock market or buying some bonds and, like we said, index funds, mutual funds, ETFs. That's what you're looking for to get that easy pool versus you going out and stock picking. But begin thinking about it, talking with your parents about different accounts, how to open them, or just in general, the route to go there. Oh, third one, talk with your parents. There you go. Talk about the building credit, the investing, saving, what should you be saving for? Or you can reach out to Joey and I, always available.
Yes, please feel free to reach out to either Carolyn or I to talk more about this. Any questions regarding investing, credit, or last week's presentation with the foundations, or if you want to talk about more of your personal situation, your personal finances, anything like that, we're more than happy to chat as well. So hope you enjoyed this. I hope you learned a little bit about credit and investing and really beginning our journey towards financial freedom, building off of financial safety and building off of the foundation we created through saving and budgeting and getting into the worlds of credit and investments. So, Carolyn, any last words?
No, I hope everyone watched the first session, and if not, go back and watch that one and reach out if you need anything or any feedback. Thank you.
Awesome. Thanks, guys.
Bye.